Welcome back to Insights and Beyond. Today, we're diving deep into a topic that's crucial for anyone interested in economics, finance, or even personal finance management. What happens when the Federal Reserve cuts interest rates? This video will cover everything from the basics of the Fed's role to the immediate and long-term effects of interest rate cuts and how they impact you personally. Stick around for a comprehensive, engaging, and data-driven exploration of this critical topic. To understand the impact of interest rate cuts, we first need to understand the Federal Reserve, commonly known as the Fed. The Fed is the central bank of the United States, established in 1913 with the Federal Reserve Act. Its primary goals, often referred to as the dual mandate, are to promote maximum employment and stable prices, along with moderate long-term interest rates. The Fed achieves these goals through various monetary policy tools, the most prominent being the control of the federal funds rate. The federal funds rate is the interest rate at which depository institutions lend reserve balances to other depository institutions overnight on an uncollateralized basis. This rate is crucial because it influences other interest rates, including those for mortgages, credit cards, and business loans. By adjusting this rate, the Fed can either stimulate economic activity or cool down an overheated economy. Understanding the Fed's role is essential because its decisions affect the entire economy, from large corporations to individual consumers. Let's explore why and when the Fed decides to cut interest rates. The Fed cuts interest rates for several reasons, primarily to stimulate economic activity. Here are some key reasons why the Fed might decide to cut rates. 1. Economic slowdown. When the economy shows signs of slowing down, the Fed may cut rates to encourage borrowing and investing. Lower rates make loans cheaper, which can boost spending and investment by businesses and consumers. For example, during the 2001 recession, the Fed cut rates from 6.5% to 1.75% to stimulate economic growth. 2. Recession. During a recession, the economy contracts, leading to higher unemployment and lower consumer spending. Cutting rates can help mitigate the effects of a recession by making credit more accessible. For instance, in response to the 2008 financial crisis, the Fed cut rates from 5.25% in September 2007 to nearly 0% by December 2008. 3. Low inflation. The Fed targets an inflation rate of around 2%. If inflation is persistently below this target, the Fed may cut rates to encourage spending and investment, which can help push inflation closer to the target. For example, in 2019, when inflation remained below the target despite a strong labor market, the Fed cut rates 3 times. 4. Global economic conditions. Sometimes, international economic issues, such as a slowdown in major economies like China or the Eurozone, can influence the Fed's decision to cut rates. Lowering rates can help protect the US economy from external shocks. For instance, the Fed's rate cuts in 2019 were partly due to global trade tensions and slowing global growth. When the Fed cuts interest rates, the immediate effects are felt across various sectors of the economy. Here are some of the key impacts. 1. Lower borrowing costs. The most direct effect is a reduction in borrowing costs. For instance, mortgage rates often decline, making it cheaper for people to buy homes. In the weeks following a rate cut, you might notice that the interest rates on new mortgages and refinance loans drop. For example, after the Fed cut rates in July 2019, the average 30-year fixed mortgage rate fell from 3.75% to 3.5% within a month. 2. Stock market. Reaction: lower interest rates generally lead to a boost in the stock market. Investors shift their money from low-yielding bonds to stocks, driving up stock prices. This is because lower interest rates reduce the cost of borrowing for companies, potentially increasing their profits. For instance, after the Fed cut rates in July 2019, the S&P 500 increased by nearly 3% within a month. 3. Weaker dollar. Interest rate cuts can lead to a weaker US dollar. Lower rates make US assets less attractive to foreign investors, reducing demand for the dollar. This can benefit US exporters, as their goods become cheaper for foreign buyers. For example, after the Fed's rate cuts in 2019, the US dollar index, which measures the dollar against a basket of other currencies, fell by about 2%. 4. Increased consumer spending. With lower borrowing costs and potentially higher stock prices, consumers may feel more confident and increase their spending. This boost in consumer spending can help drive economic growth. For example, after the Fed cut rates in 2008, consumer spending on durable goods like cars and appliances increased, contributing to economic recovery. While the immediate effects of a rate cut are often positive, the long-term impacts can be more complex. Here are some key considerations. 1. Inflation. Over time, lower interest rates can lead to higher inflation. If the economy grows too quickly, demand can outstrip supply, leading to rising prices. The Fed must balance stimulating the economy with keeping inflation in check. For example, in the late 1960s, the Fed's decision to keep rates low contributed to high inflation in the 1970s. 2. Asset bubbles. Prolonged periods of low interest rates can lead to asset bubbles. Investors seeking higher returns may pour money into assets like real estate or stocks, driving up prices beyond sustainable levels. When these bubbles burst, they can lead to economic downturns. For instance, the low interest rates in the early 2000s contributed to the housing bubble that burst in 2008. 3. Debt levels. Lower interest rates can encourage excessive borrowing by consumers. High levels of debt can become problematic if economic conditions deteriorate, leading to defaults and financial instability. For example, the increase in corporate debt during the low-rate period following the 2008 crisis raised concerns about potential defaults during future downturns. 4. Savings rates. Lower interest rates can negatively impact savers, particularly retirees relying on interest income. If returns on savings accounts and bonds are too low, savers may struggle to meet their financial goals. For instance, after the Fed cut rates to near zero in 2008, the average interest rate on savings accounts fell to below 1%, significantly reducing income for savers. Let's look at some historical examples of significant rate cuts and their impacts. 1. 2008 Financial Crisis. During the 2008 financial crisis, the Fed slashed rates from 5.25% in September 2007 to nearly 0% by December 2008. This aggressive rate cut aimed to stabilize the financial system and stimulate the economy. While it helped prevent a deeper recession, the recovery was slow, and the low rates contributed to subsequent asset bubbles. 2. Early 2000s. In the early 2000s, the Fed cut rates to combat the dot-com bubble burst and the 9/11 attacks. Rates were reduced from 6.5% in 2000 to 1% by 2003. This period of low rates is often cited as a contributing factor to the housing bubble and the subsequent 2008 crisis. 3. 2019 Rate cuts. In 2019, the Fed cut rates 3 times, reducing the federal funds rate from 2.5% to 1.75%. These cuts were preemptive measures to counteract a global economic slowdown and trade tensions. The cuts helped sustain economic growth and supported the stock market, which hit record highs. While many view rate cuts as a positive move to stimulate the economy, there are differing perspectives. 1. Keynesian view. Keynesian economists generally support rate cuts during economic downturns. They argue that lower rates boost aggregate demand, leading to higher employment and economic growth. For example, the Keynesian perspective supported the rate cuts during the Great Recession to stimulate demand. 2. Austrian school. Economists from the Austrian school are often critical of rate cuts. They believe that artificially low rates distort market signals, leading to malinvestment and economic imbalances. For instance, they argue that the low rates in the early 2000s led to excessive investment in the housing market, creating a bubble that eventually burst. 3. Modern monetary theory, MMT. Proponents of MMT argue that rate cuts are less effective in modern economies where fiscal policy should play a more prominent role. They advocate for direct government spending to achieve economic goals rather than relying on monetary policy alone. For example, MT proponents suggest that instead of cutting rates, the government should increase spending on infrastructure and social programs during downturns. But what are the global implications of US rate cuts? US interest rate cuts have significant implications for the global economy. 1. Emerging markets. Lower US rates can lead to capital flows into emerging markets seeking higher returns. This influx of capital can boost growth in these markets, but also create vulnerabilities if the capital is suddenly withdrawn. For instance, after the Fed's rate cuts in 2019, emerging markets like Brazil and India saw increased capital inflows, boosting their economies. 2. Global trade. A weaker dollar resulting from rate cuts can make US exports more competitive, reducing trade deficits. However, it can also lead to trade tensions as other countries may respond with their own monetary policies. For example, the rate cuts in 2019 contributed to a weaker dollar, benefiting US exporters but also leading to concerns about competitive devaluations. 3. Global interest rates. US rate cuts often influence other central banks to adjust their policies to maintain economic stability. For instance, following the Fed's cuts in 2019, several other central banks, including the European Central Bank and the Bank of Japan, took similar actions to support their economies. The Fed's communication strategy plays a crucial role in the effectiveness of rate cuts. 1. Market expectations. Clear communication from the Fed helps shape market expectations and enhances the effectiveness of monetary policy. When the Fed signals its intentions, markets can adjust accordingly, making the policy more impactful. For example, in 2019, the Fed's clear communication about potential rate cuts helped stabilize financial markets. 2. Credibility. The Fed's credibility is essential for maintaining market confidence. Consistent and transparent communication helps build this credibility, ensuring that market participants trust the Fed's actions. For instance, the Fed's credibility was crucial during the 2008 crisis when it took unprecedented measures to stabilize the economy. 3. Transparency. Transparency in the Fed's decision-making process helps businesses and consumers make informed decisions. By providing insights into its economic outlook and policy considerations, the Fed can reduce uncertainty and support economic stability. For example, the Fed's regular press conferences and detailed minutes of its meetings provide valuable information to the public. Let's now focus on how interest rate cuts affect the daily lives of regular consumers. 1. Mortgages and loans. Lower interest rates mean cheaper loans. For example, if you're looking to buy a home or refinance an existing mortgage, a rate cut can significantly reduce your monthly payments. Suppose you have a $300,000 mortgage at 4% interest. A cut to 3% can save you over $150 per month, amounting to nearly $2,000 annually. This reduction can make home ownership more accessible and free up funds for other expenses. 2. Credit cards and personal loans. Credit card interest rates typically drop following a rate cut, reducing the cost of carrying a balance. For instance, if you have $10,000 in credit card debt at an 18% interest rate, a 2% rate cut can save you about $200 annually in interest. Personal loans for major expenses like home improvements or medical bills also become more affordable, easing financial burdens. 3. Savings accounts and CDs. Borrowing becomes cheaper, savers earn less interest on their deposits. If the interest rate on your savings account drops from 2% to 1% on a $10,000 deposit, you'll earn $100 less per year. This can be particularly challenging for retirees relying on interest income. To offset this, some savers might seek higher returns through investments in stocks or bonds. 4. Stock market. Investments. Lower interest rates often boost the stock market as investors seek higher returns. If you have a retirement account or other investments, your portfolio might see higher returns. For example, following the Fed's rate cuts in 2019, the S&P 500 rose by nearly 3% within a month, benefiting investors. 5. Consumer confidence and spending. Cheaper credit and a stronger stock market can boost consumer confidence. When people feel more financially secure, they're more likely to spend on big-ticket items like cars and appliances, which stimulates economic growth. For instance, after the rate cuts in 2008, consumer spending on durable goods like cars increased, contributing to economic recovery. 6. Job market. Lower interest rates can lead to job creation as businesses expand and invest more. For example, during the recovery from the 2008 financial crisis, lower rates helped companies finance expansion and hiring, reducing the unemployment rate from a high of 10% in 2009 to 4.7% by 2016. 7. Inflation impact. While moderate inflation can erode purchasing power, the goal is to keep it stable around 2%. Rate cuts can help prevent deflation, which can be more harmful as it leads to decreased spending and economic stagnation. However, if rates are kept too low for too long, it can lead to higher inflation, increasing the cost of living. 8. Real estate market. Lower mortgage rates can stimulate the real estate market. More affordable borrowing costs can increase demand for homes, potentially driving up home prices. This can benefit homeowners through higher property values, but may make it harder for first-time buyers to enter the market. For instance, after the Fed cut rates in 2019, home sales surged and home prices rose by about 5% nationally. In conclusion, when the Fed cuts interest rates, it's a significant event with wide-reaching impacts. From lower borrowing costs to changes in the stock market, understanding these effects can help you make better financial decisions. Whether you're looking to buy a home, invest in the stock, or simply manage your finances, being informed about monetary policy is crucial. Thank you for joining us today on Insights and Beyond. If you found this video informative, please like, share, and subscribe for more in-depth analyses on trending topics. Leave your comments below. We'd love to hear your thoughts on interest rate cuts and their impact on your life. See you next time.